So, Trade Republic just made private equity accessible to everyone. Something that used to require millions to access can now be added to a portfolio starting from an investment of only €1 in private equity funds from Apollo and EQT with an advertised target return of 12% annually. Sounds like a no-brainer, right? Well, before you jump in, there are some important things you need to understand. First, these funds are many times more expensive compared to regular stock market ETFs. Second, the 12% target return, especially for you as an investor, is far from guaranteed. I'd even argue unlikely. And third, there may be better ways to gain private equity exposure if that's what you're after. If you're new here, my name is Angelo, and I've been investing in low-cost ETFs for over 8 years with my wife, with the goal of retiring early one day. Today, we're exploring whether private equity makes sense for everyday investors like us, and spoiler alert, the answer might surprise you. Let's start with the basics though. Private equity means investing in companies that aren't publicly traded on the stock market. You may be surprised to hear that as many as 88% of companies worldwide are private, not public. So you're potentially accessing a much bigger investment universe. And it's true that the best private equity funds, especially those focused on buyouts, have outperformed the stock market over the past few decades. Recently, Trade Republic partnered with two major players in the private equity space, Apollo based in the US and EQT based in Sweden, offering these investments through ELTIFs, European Long-Term Investment Funds. Thanks to recent EU reforms, these are now available to retail investors, which you could argue is genuinely a step towards democratizing finance. And with a minimum investment of only €1, you can now easily access these funds on Trade Republic. But does that mean they're actually worth your money? Well, let's look at what the marketing doesn't tell you. Let's talk about something crucial, the fees. And this is where things get quite different from ETF investing. Trade Republic is offering two funds, the Apollo Global Private Markets ELTIF, which charges 2.8% annually plus a 12.5% performance fee if it returns above 5% in a year, and the EQT Nexus Fund at 2.35% annually plus a 15% performance fee if the yearly return is above 5%. For comparison, as of 2025, you can invest into a passively managed MSCI World ETF with fees as low as 0.06% per year. So this means we're talking about fees that are 60 to 70 times higher in a good year and still 40 times higher even in years when the performance fee doesn't kick in. Let me show you what this means in practice. On €10,000 invested over 10 years, you'd pay around €60 in total fees with a low-cost world ETF. Meanwhile, with these private equity funds, you would easily be paying several thousand euros in fees over that same decade. That is an enormous difference you need to be aware of. Before we move on, you can find my favorite brokers for low-cost ETF investing in Europe linked down below, which is a great way to support me if you'd like to. Now, Trade Republic mentions a 12% target return, which sounds amazing. But let's clarify what this actually means. First, this is a target, not a guarantee. It's based on historical private equity performance and is likely derived from numbers like these. Since its inception, EQT has been able to achieve an internal rate of return of 21% on its private capital investments in Europe and North America and 16% in Asia. And Apollo promotes a net internal rate of return of 24% since its founding, which is certainly impressive, don't get me wrong. But here's the problem. You can't fairly compare a private equity firm's IRR to an MSCI World ETF's average 10% annual return over the past 46 years, as they're measuring completely different things. In private equity, the money goes in and out at different times, which can inflate the internal rate of return, making it look more impressive. Also, these numbers include all of their best exits since EQT and Apollo were founded. Who is to say they're going to perform anywhere close to this well in the future? For you as an investor to actually see a 12% return after all fees are accounted for in any given year, the underlying investments would need to generate returns close to 17%. Let me say that again. The fund needs to return 17% for you to get 12%. That's a massive gap. And unlike an ETF that passively tracks an index, often containing thousands of the most successful publicly listed companies from all over the world, these funds are a lot more concentrated. They might only hold 10 to 30 companies, for example. This results in less diversification and higher risk, with their returns heavily depending on the fund manager's skills and the specific deals they make. Now let's talk about liquidity, because this is where things really differ from ETF investing. With ETFs, you can sell anytime the market is open. The choice is yours. With private equity, it's much more complicated as your money is tied up. These funds are designed for long-term holding, ideally 10 years. While Trade Republic offers an internal marketplace where you can sell on a monthly basis, this doesn't guarantee you can sell when you want, as you need a buyer on the other side of the trade. To show you how illiquid private equity funds typically are, look at the BlackRock Private Equity Fund on Scalable Capital. They don't allow any redemptions for the first 2 years. And even after, redemptions are only quarterly and limited to just 5% of the fund's net asset value. At that rate, getting your full investment investment back could take many years. Look, being locked in for a decade isn't necessarily a deal breaker if you understand what you're getting into, but you should know what's happening in the private equity industry right now. Bloomberg recently reported that distributions have slowed so dramatically that it would take about 9 years for investors to collect their money from US private equity buyout funds at current rates, as more private equity firms are struggling to exit their investments at the valuations they promised. This context may explain why private equity is now becoming available to retail investors. The industry is looking for new capital sources, while institutional investors have become more cautious. If you're interested in private equity but concerned about the costs and liquidity constraints, there are some alternatives you could consider. First, you could hold shares of Apollo or EQT directly if you believe in their skills. Both companies are publicly listed, so you could directly participate in their success without the fund fees by buying their stock using interactive brokers. Or option number 2, cover the private equity sector via an ETF containing private equity stocks as a whole. For example, the iShares listed private equity, replicating the S&P listed private equity index, containing private equity stocks from North America, Europe, and Asia Pacific, including EQT and Apollo. And even with its higher than average ETF fees of 0.75% per year, this ETF actually managed to outperform MSCI World ETF since 2009, which is very impressive. And 0.75% is still nowhere near the 4 to 5% you would pay with these private equity funds in a good year. If you're interested, you can find more information about the underlying index itself on the S&P Global website. I also added the ETF ticker symbol in the description below. Alright, let's finally answer the question. Should you invest in private equity? In my personal, honest opinion, I believe most investors trying to build wealth over decades are better off just sticking to well-diversified, low-cost ETFs. My wife and I only buy the accumulating Invesco FTSE World on a monthly basis, for example. Having said that, since 88% of the companies worldwide aren't publicly traded, I do think it's positive that private equity is becoming more accessible to private investors like us. Would I personally add Trade Republic's private equity funds to my portfolio? No. And here's why. For me, their fund and success fees are too high. I don't like not having certainty over when I can get all my money out if needed, and they're not diversified enough for how I like to invest. What I would do instead if I wanted private equity exposure is to buy and hold an ETF like the iShares listed private equity and cover the sector that way. Yes, its fee is higher than a typical world ETF, but still nowhere near the private equity funds we looked at today. And its track record has been excellent so far, even beating the MSCI World since 2009. You can find it using the ticker IPRV on both Trade Republic and the interactive brokers. My links to both of them are down below, which is a great way to support me if you'd like to. Just keep in mind, we're talking about an ETF covering a specific sector. So if you decide to add it to your portfolio because you believe private equity will continue to outperform, I would limit your position to a maximum of around 10%. I certainly wouldn't make it the core of your investments just because of its promising past performance. What is your take? How do you feel about private equity, either with the new funds or the ETF I mentioned? Let me know in the comments. And if you want to know exactly how not to invest as a European, aka the most fun I've had so far recording a video, you'll need to watch this one next. Also, nothing I mentioned today is investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.